So it gives me great pleasure to introduce Gary, who's going to be talking about risk in payments across the ecosystem. Gary has spent most of his career worrying about payments and payment risk, and is going to share his perspectives on how security, and in particular payment security, shares commonalities with all security systems, where actually so many choices you make in security systems turn into economic choices, right? So kind of making fraudsters attacking your systems like, a low ROI activity for them. So without further ado, Gary, over to you. Thank you.
Thank you, Karthik. So today I am going to talk about risk and payments. Risk and payments are two distinct teams. So at a lot of businesses or companies that you work at or that you interact with, they have different incentives. So a payments person might want to introduce a new wallet, a new payment option, but a risk person will want to reduce chargeback rates to zero, reduce fraud rates to zero. And so these guys, they sit on opposite sides of the aisle, but they aren't necessarily on the same team, but they work at the same business. When we talk about the ecosystem, think about this morning when you woke up, you went downstairs for a cup of coffee, you went for breakfast, you came to the convention center via rideshare or via taxi. Every single business that you interact with on a day-to-day basis involves payments and risk. And every single one of these businesses has a risk and payments function. And so today we'll be talking about some of the differences around the industries that I've worked at that are in the payment space, but also really how risk and payments are incentivized to work together from a financial perspective versus something else like compliance or some other sort of risk. As a quick intro, I'm Gary. I started off, unfortunately, at a bank helping corporates and financial institutions hedge their FX risk. About 15 years ago, I joined a US DVD company. They were just starting to introduce streaming. So the first market that they chose was Canada, which is a bit of a softball from an international expansion standpoint. And then they went to LATAM. And so the LATAM region is tremendously challenging from a fraud and payments perspective. 15 years ago, there was no Pix in Brazil. Everything was installments, everything was vouchers. I think they would have done things differently if they knew what was in store for them. They might have chosen a different country or a different region. Most recently, I have been at marketplaces, which are tremendous at moving money quickly and securely from one place to another. And this is what's the most complex, but also what's the most captivating as far as the types of services and products that you can offer. Okay, so let's start as a payments analyst. And so there's two types of analysts. There's a payments analyst and there's a risk analyst. A day in the life of a payments analyst is you've just launched in South Korea. What should your business do to increase business? And so as a very good payments analyst, I see that my conversion is terrible. So my exec team, my board has told me that my conversion rate is 20%, which is not zero, but it's pretty close to zero, and I should double it. And so as a good analyst, I look at the landscape, the payments landscape in Korea. I see that there's 50 million people, 95% of them have a mobile device, 95% of them check out with a messaging app called Kakao. And so as a payments analyst, I decide to launch Kakao Pay. So Kakao Pay there's a lot of all-in-one apps in Asia, Kakao included, where they have payments, but they also have messaging, they have other types of capabilities that allows people to communicate and work together. Kakao Pay is, I'm a super smart payments analyst. This is what I'm going to launch in order to increase the conversion rate. And so next, I look at the checkout flow. So as for card not present payments, you always check out online. This is a very standard payment form. It can autofill on Chrome. It can be scored from a risk perspective from a vendor like Civ Science, and you can kind of figure out what is the risk of that checkout. If I choose something local like Kakao Pay, I might get something like this, which is something that my risk team will be super happy with, which either is a Face ID or a PIN, and at the end of the day, the payment is successful. And so this is the first half of my day as a payments analyst. The second half is the cost. And so I work with a local Korean PSP, like Inesys or like a Korea Cyber Payment. I could work with a Stripe or an Adyen or a Braintree, but there's some sort of cost associated with this payment. I am very good at negotiating, so I can reduce that 15 cents plus 300 basis points. Everyone knows that presenting in local currency increases conversion, so I will present in Korean won, and my treasury team is asking to settle like for like. So I can choose either Korean won or USD, but I will choose Korean won to save on foreign exchange costs. At this point, I involve my risk team or my risk analyst. And so refunds are super important. This payment method supports refunds as well as partial refunds. From a user experience standpoint, it's important to give them back their money when they need it, and so that's why that's useful. 3DS, as you saw in the earlier presentations, it's card related. It's not related to a local payment option like Kakao Pay, and chargebacks are not relevant here. So from a operational perspective, it's convenient that there's no chargebacks. It's one way for this payment to be accepted in Korea. There's no local entity, so I can use my US entity to offer this payment option. I don't need to open an office. I don't need to open headcount to hire people in Seoul. The settlement delay is 5 days. It's actually convenient for my risk team because it gives them time to investigate. It gives them time to stop the transaction if needed. And it's actually something that we agree on. And finally, recurring. For something that's low ticket and recurring, it's useful. But if I'm selling plane tickets, it doesn't matter if it supports recurring or not. Okay, so now as a risk analyst, and so I'm moving from the payment side to the risk side. The risk analyst, the most important thing that they want is a right of first denial. They want to be able to score the checkout before it goes to the payment processor. And so they can allow the payment to go to a Stripe, they can allow the payment to go through some sort of manual review, or they could turn down the payment altogether. And so a lot of risk teams, they want to step in within 200 milliseconds, make a risk decision, score that transaction, and be able to stop it before it even goes downstream to a payment processor. And so risk teams, they always talk about metrics. And so risk, they have a ton of metrics, much more so than the payment side. Refund and chargebacks are typical. Chargebacks you must keep below 100 basis points, otherwise you'll be in some sort of Visa, MasterCard remediation program. A fraud loss or fraud to gross is the realized fraud divided by the gross merchandise value. It's a very, very common metric to use at the highest level when talking to leadership or talking to board members. Precision and recall, they measure the efficacy of a risk model. Historically, in my past, I've seen recall be more important than precision. As a product person, I can prioritize a seamless remediation process, so false positives don't hurt as much if I'm able to give the user a way to fix whatever was flagged. Recall is much more hurtful because every true positive that gets through my checks is financial loss for me. And if you have a credit program, so if you lend money, if you have a capital program, if you issue cards, then write-offs and delinquencies are super important because delinquencies, they are a leading indicator of the amount of loans that you're going to have to write off at 200 days. And so risk people like to talk a lot about metrics, payments people not so much, more so about the user experience. But at the end of the day, a lot of the leaders and previous companies that I've worked at, they're telling us or telling me that our role is to reduce existential risks. And so there's risks, financial risk that will make it so that you have no business tomorrow. You will be completely wiped out. Imagine if Amex weren't able to collect on their receivables over the next day or two because of some bin attack or something that happened. Financial risk is the number one concern of companies that you interact with on a day-to-day basis. It trumps things like compliance or third party or operational risk. This is a chart of a real company, their monthly revenue over time. You can see that on some month, there's an event that brings revenues to zero. And so at this point, it's very, very hard to recover from an event like this. And so you must always keep financial risk top of mind, regardless of if you are on the payments or on the risk side. And so this is a matrix. There's many more numbers than this. These are some kind of standard metrics for payments like auth rate, for risk like fraud to gross. All of these things actually don't matter. They're considered secondary metrics in a lot of top tier companies because the focus is on the actual dollar amount. You have a business to run. You have to make sure your revenues are growing or at least greater than zero. You want to reduce your costs and minimize the losses that you experience, whether they're credit or fraud losses. And so now that you've seen, you can understand what it's like to be a risk analyst or a fraud analyst. And you know the priorities as well. And so we will get into a few different industries. And so the first one is low ticket recurring digital. This could be a Spotify, this could be a Netflix, this could be an Amazon Prime. Typically there's a free trial, although free trials are going away for a lot of more well-known recurring billers. They typically have low value. Low value used to mean $10 nowadays because of inflation. Low value is $20 to $25. It's typically recurring and it's high margin. And so what you give your subscribers is access. And so access scales very quickly globally. And so as a company, your goal is to maximize the number of subscribers. Each subscriber has an LTV attached to them, so maximize the amount of revenue you get from your subscribers. As a risk or a payments team, these are a few areas that you could focus on: localizing payments, controlling free trials, monitoring refunds and chargebacks, enabling more accounts while reducing sharing. So Netflix Household is an example of reducing sharing. You have to be on the same devices, in the same Wi-Fi, in the same location. Otherwise, my dad lives in another state. I have to buy him or subscribe him and pay more for that option. A lot of the projects that you see for recurring companies is launching new payment options. Venmo is a US-only wallet. Konbini and OXXO are convenience stores in Japan and Mexico. Gcash is a wallet in the Philippines. Boleto is an invoice option in Brazil. These local options help you reach your subscribers, and at the end of the day, it's an economic exercise, and if it increases the number of subs, it increases revenue. Something else that companies in the recurring space have played with is free trial. So a lot of them have taken free trials away because of the card testing and the additional liability from having bad cards on your platform at free trial. We also want to enforce rejoins. If you stream at least 10 minutes, you do not get a free trial anymore and you have to subscribe, and you're counted as someone that's rejoining the service. And so this reduces the amount of bad first payment when we try to charge you for the first time, and increase subs. And so everything is geared towards driving the business, having some sort of positive number that comes out after you do everything that you need to do. Lockdown sharing, we just talked about this. This has been hugely additive for certain recurring billers. And finally, optimizing retry, the ability to retry a payment card without having to ask the user to provide another one. Many times your payment might fail because of insufficient funds. People in the US are paid on Fridays, and so there are higher approval rates when you retry the card on a Friday so that they come back and retain that sub versus dropping out and losing them for the future months. And so this is just an example of a few different projects recurring billers look at. If you look at recurring in the past, there always used to be a free trial. If you cancel mid-month, you get half of your month back, but nowadays that doesn't happen. And so a lot of people, to drive revenue, they take away the free trial, so there's additional revenue from the first month, and instead of allowing you to get half your month back, they give you service until the end of the month so that they capture the second half of that revenue for the month. This again is a real chart from a real recurring subscriber or subscription company, and their revenues have increased over time because of some of these policies that they've put in place. Okay, now to our second industry. This is completely different. This is the travel industry. Think rental cars, black cars, flights, hotels. It is pay now or pay later. Sometimes if you pay earlier, for example, for a hotel, it's cheaper. If you pay later with a card, it's more expensive, but you have more flexibility. It's typically high dollar value, so thousands or tens of thousands of dollars. There's no recurring. It's usually a one-time transaction to book the trip, and it's average margin. If you think about booking a hotel room, hotels have big margin, and so as a platform, you have large margins from people booking hotels on your platform. Flights are lower margin, and so if you look at your travel platform overall, it's going to be a blend of rental cars, which is in between, as well as flights, which are low margin, and hotels that are high margin. And what the user gets is travel. Risk and payments teams, what's new here is suppliers. A lot of the inventory comes from suppliers. You don't produce it yourself. We want to keep everyone on the platform, so we want to enable multiple modes of transport. We need to monitor travel policy. If you've ever booked a flight with your company, whoever you work for, there are restrictions because they want to reduce the leakage on that travel. Ultimately, we want to enable more travel choices, and some of the examples are like, it doesn't matter if you're a big chain or a small chain, CCAs or credit card authorizations are really popular. They allow the company to send a corporate card without using your card to be on file. We have MCC controls to ensure that the cards are spent at a hotel or a timeshare and not something else, and this reduces loss. And so at the end of the day, business is an economic exercise, and we want to keep losses low. If you talk about flights, travel agents or travel platforms, they are on the hook for chargebacks. And so American Airlines, Alaska Airlines, they will come back to the travel platform if there's any chargeback on their booking and get it from the booking platform. So it's very important to reduce the number of chargebacks. And when you look at bad bookings, there's a lot of indicators of if a booking is bad. For example, if there's no price sensitivity, they're using a stolen card, they can book $10,000 or $20,000 ticket without a problem. There are certain airports and regions in the world that are considered riskier, and they also try to book very, very rushed, 1 or 2 days in advance, versus your corporate policy probably says something like book at least 2 weeks in advance. There's a lot of clues that tell you if a booking is bad, but of course this varies over time. And finally, we're getting a little bit fancier here, but for flights, there's ways to control how that is spent based on your policy. So for a certain individual or department, or if the flight is over 6 hours, you can spend up to X amount. If not, then the card will be declined. So this has been really popular for a lot of travel platforms, especially in the corporate space. Okay, so what travel used to be from a payments and risk perspective is a paper form, credit card authorization with all PII and PANs written and in the public for everyone to see. This has changed to one-time use virtual cards. Fax is still not super secure, but emails can be secured. You don't know who's working at the front desk. The vast majority of them are good. You are able to digitize this experience and not open up the card for misuse before the trip or after the trip. And so this is just some of the so-called innovations, I suppose, over the past few years in corporate travel to keep spend where it should be. Okay, now on to the third industry, which is marketplaces. What's new here is the disbursement piece. It is two-sided. Marketplaces thrive on connecting the acceptance to the disbursement, so you connect the supply to the demand. The value could be quite different depending on if you're ordering from a nice restaurant or ordering from McDonald's. So the ticket size could really differ. There are recurring and one-time transactions here from a payments perspective because a lot of these platforms, they offer subscriptions to reduce the cost of your one-time transaction. So they call it Ride Pass, One Pass. A lot of these things, they try to keep revenue steady while offering you discounts on the one-time transactions. The variable margin, it depends on the type of goods that you're getting. It could be your ordering food online, you're getting a car, but it could also be a course. A lot of courses like from Udemy, they could be expensive if they're not on sale. And so the margin really depends on the time and the good that you're getting. And the most important thing for marketplaces is earnings or income. So you want to get donations to the fundraiser that needs it. You want to get earnings to the driver that drove you to the convention center. You want to get the money to the courier that delivered your food to your house. And so the main focus of a marketplace is to get earnings and reporting and money to where it belongs, which is the supply side. Some risk and payment items that could happen for a company like this are localizing payments, very similar to the recurring example. We are controlling losses so that our supply side can get as much income as they need. Onboarding is brand new. So we didn't have to onboard anybody for the travel use case or for the recurring use case. We have to onboard drivers. We have to onboard couriers so that we know who we're working with. And finally, the main point of a marketplace is to enable more supply. And so once you have the supply, then you drive demand to the products that you're offering on the platform. So some of the initiatives that happen in a industry like this are cards. And so there's a lot of co-brand cards. Traditionally, the parties that make money on co-brands are the issuing bank and the network. So think Visa, MasterCard, and the issuing bank. It could be Barclays, it could be Wells Fargo. Merchants are getting into this, and so the Uber card is shown here, but there's a lot of marketplaces that also can earn some sort of rev share from the issuing bank or from the network. You have to provision for credit losses. If you extend credit, then you want to make sure that when you add up everything, it stays positive. And then instant payouts from a payments perspective is super helpful for people to get it real time 4 or 5 times a day instead of waiting a week or waiting at the end of the day. And so these are all things that can be monetized from a marketplace perspective. There's also manual onboarding. We were having a conversation earlier with some folks here where a lot of the best instructors, a lot of the best drivers, they don't want to go through your digital onboarding. They want to actually meet with somebody and show them their driver's license. So a lot of the best people that you get will not go through your digital experience, and so this adds to the earnings on the platform. On the fintech side, there is a push towards wallet. If you're able to store funds on a wallet, you earn the interest, almost like a bank. If you lend money, you do have to keep an eye on your defaults because that is a loss to you, and it's only worth it if you can come out net positive. On the credit and gift side, you'll notice that like Amazon, they give you refunds as a credit. This is a strategy to keep the funds on the platform. If you refund as credit, it almost keeps, it's almost like a closed loop gift card where you keep the funds on your platform. And so this is another way that marketplaces monetize. Gift cards can be for Walmart, for Amazon, for Home Depot. The merchant provides a rev share for that if you offer the gift cards on your platform. So these are a bunch of different ways that marketplaces try to stay positive from a business perspective while leveraging their risk and fraud teams. Okay, and in the past, as you all know, marketplaces, they start off as one thing, like a ride-sharing service, and then they expand to a bunch of different things. So like delivering carrots, serving your corporate customers, sending boxes, sending medical supplies, or helping the elderly get to their medical appointments, local transport options like scooters and bikes. Future is like self-driving. There's Waymos everywhere now, it seems like. Localization consulting because they know the local market really well, and lending. And so what starts off as one thing becomes a lot of different things after they've perfected what they're trying to do by connecting supply and demand. Okay. Last industry I'm going to cover today is card issuing. And so card issuing has been democratized. Stripe issues cards, Adyen issues cards. You don't have to be a bank to issue cards. If you've ever applied for a car loan or a home loan, you know that there's underwriting. So I have to determine if I will give a credit limit to a dental office down the street based on bank statements and financial statements that they provide. There's a lot of high velocity transaction. This is huge for fraud. There are BIN attacks that happen on these platforms because they know the BIN that Stripe issue is, and so they try to brute force the rest of the pan. There are physical and virtual cards. It is fairly low margin. It's in the hundreds of basis points instead of the thousands of basis points, and the goal is to enable spend. The risk and payment teams that issue cards, they focus on fraud using stolen or synthetic identities. They want to protect against BIN attacks. A lot of you learned about BIN attacks or brute force attacks through the card attack session a few hours earlier. ATOs are really hurtful in this case because account takeovers of a spend limit of $1 million means that you can spend $1 million. And so it's really important to protect your customers from being phished or being tricked into giving their credentials to a bad actor. Onboarding is very important. Onboarding small companies like a dental office down the street is very different from onboarding a big enterprise customer. And then similar to travel, there's also expense policy, the ability to control by MCC, by spend limit, what that card is used for. And so you'll see that expense and travel are kind of similar, but they try to do the same thing, which is limit the amount that can be spent in some given amount of time. And so some projects that are in the issuing space are better verifications. There's a lot of vendors that do this. There are vendors that check for the authenticity of a bank document. It could be doctored. You could change the 8 to 88, and so you could show that you have more funds than you actually have. There's tools to check the domain, the individual risk, as well as the email, as well as match everything together across email address and name so that you know that you're properly KYCing whoever you're extending credit to. Transaction controls and dynamic rules. Someone like an Amex, if you've had an Amex Platinum or some other sort of Amex card, they don't have a predefined spend limit because they measure the risk at the time of transaction. So it's very important for a card issuer to have transaction controls, dynamic rules that reflect the current state of affairs versus a year ago, and you're able to offer a limit, a high limit, or no limit, depending on the types of controls that you have. Expense policy. So this is for entertaining. If you work at a corporate company, you understand that depending on your level or depending on your team, you can spend $100 or $1,000 on entertaining customers or entertaining your colleagues. There's a threshold at which that would decline. There's a threshold at which that would be flagged. And all of this is now configurable on the card itself. So it doesn't matter if it's a physical card or a virtual card, you can actually configure the types of rules that you have to make sure that your expense card isn't abused. Okay, so in the past, card issuing, this is a form that you sign, like a corporate policy, the expense categories that you have available. This is what used to happen. Nowadays, you can do this through API, or you could do this through a UI, where you can actually lock the spend limit every day, every week, every month to a certain amount based on some MCC. So you could lock it to accounting services. The two snippets of code that we have here, car rental agencies, you can only use this card for a car rental up to $8,000 per authorization, which is a lot. The second example is $4,000 weekly. So you can spend on this card $4,000 at a fast food or a quick service restaurant. It gets very, very specific as far as like how you can use this card. And a lot of companies and corporates have gone this direction in order to reduce the amount of leakage and loss in their books. We've covered 4 industries. If you map everything according to a financial North Star, green is low, yellow is medium, red is high. If you zoom back and take a heat map view, you can see that the riskiest businesses from a financial standpoint are card issuing and marketplaces. So I'll give you an example. An account takeover on a digital subscription is much less loss than an account takeover of a credit card account with $1 million in spend limit. Another example could be a synthetic ID used on a digital subscription is very much lower loss probability of misuse versus a marketplace or a card issuing company. And so this will give you an idea of how financially risky and how viable these businesses are by mapping the different risk types to the probability of financial loss. Okay, so takeaways today. I'm thinking about account takeovers, but takeaways today, financial incentives, they drive decision making at businesses that you work with day to day. It's primarily an economic challenge. Ensuring the survival of the business is the first priority. This helps simplify the North Star across payments and risk teams as well as stakeholders. If you want to map KPIs, the number of good user accounts, uptime percentage, and number of good insiders like employees, these are very common. These are secondary metrics. They really should be something like the revenue gain by having good user accounts, the revenue loss by not having your payment processing system up, or the cost saved by clearing internal employees. If you have $20,000 loss per bad employee, this is the amount of money that you save. And so at the end of the day, we focus on the financials for a risk and payments team, not necessarily the secondary KPIs, which I think more people are familiar with. That's it. Thank you all.